J&J operates in three main businesses: pharmaceuticals, medical devices, and consumer products. Each of these has characteristics that make them relatively recession-proof and inflation-resistant. The pharmaceutical business is the largest and most profitable. J&J develops and sells prescription drugs for serious medical conditions: cancer, immunological disorders, infectious diseases, neurological conditions. These aren't discretionary purchases. When someone has cancer or rheumatoid arthritis or HIV, they need medication regardless of economic conditions. They don't defer treatment because of recession fears. They don't stop taking medicine because of inflation. This creates incredibly stable demand for J&J's pharmaceutical products. People will prioritize healthcare spending over almost everything else. Insurance companies and government programs will pay for essential medications even when they're cutting other costs. J&J's pharmaceutical pipeline is also exceptional. They have dozens of drugs in development for large, addressable markets. Their immunology franchise, which includes drugs like Humira, competitor Tremfya, could generate tens of billions in annual sales over the next decade. The medical devices business is similarly defensive. J&J makes surgical instruments, orthopedic implants, contact lenses, and other medical equipment that hospitals and doctors need to treat patients. Like pharmaceuticals, medical device demand is relatively inelastic. Hospitals don't stop performing surgeries during recessions. People don't delay joint replacements indefinitely. Eye doctors don't stop prescribing contact lenses when the economy weakens. J&J also benefits from an aging global population that will require more medical care over time. As baby boomers age, demand for pharmaceuticals, medical devices, and healthcare services will increase regardless of economic cycles. The consumer products business, which makes Band-Aids, Tylenol, baby shampoo, and other everyday items, is the smallest division but provides additional stability and brand recognition. From a financial perspective, J&J is exceptionally strong. They generate over $25 billion in annual free cash flow. They have one of the highest credit ratings in corporate America. They've maintained profitability through every economic downturn for decades. The dividend is particularly attractive. J&J currently yields about 3%, which provides meaningful current income. But more importantly, they've increased the dividend every year for over 6 decades, which means shareholders benefit from growing income over time. This dividend growth is powered by consistent earnings growth and strong cash generation. Even if J&J's earnings growth is modest by technology standards, growing 5% to 8% annually, that's sufficient to support continued dividend increases and share price appreciation. J.P. Morgan. We view J&J as the ultimate defensive stock. When our clients want exposure to healthcare, when they want predictable dividends, when they want to reduce portfolio volatility, J&J is always on the recommended list. But J&J isn't just a defensive play. They're also positioned to benefit from several long-term growth trends. The global population is aging rapidly. In developed countries, the percentage of people over 65 is increasing every year. Older people consume significantly more healthcare than younger people, which benefits pharmaceutical and medical device companies. Healthcare spending, as a percentage of GDP, continues to increase in virtually every country. This isn't just because of aging populations, but also because of advancing medical technology that can treat previously incurable conditions. Emerging markets are developing healthcare infrastructure and expanding access to modern medicines and medical devices. This creates new markets for companies like J&J that have global reach and regulatory expertise. Precision medicine and personalized healthcare are creating opportunities for high-value treatments that command premium prices. J&J is investing heavily in these areas and has several promising therapies in development. From a valuation standpoint, J&J is reasonably priced. The stock trades at about 15 times earnings, which is modest for a company with such stable cash flows and growth prospects. At J.P. Morgan, we have J&J rated as a buy, with expectations for 8% to 12% annual total returns over the next 5 years, including dividends. Now, let me explain why I'd buy these two stocks specifically, and why I think they work particularly well together. First, they provide balance. Microsoft is a growth stock that could generate 15% to 20% annual returns if their AI and cloud strategies succeed. J&J is a value and income stock that should provide 8% to 12% returns with much lower volatility. Together, they give you exposure to both growth and stability. Technology and healthcare. Higher risk, higher reward, and low risk, steady reward. Second, they're both defensive in different ways. Microsoft benefits from the fact that businesses can't function without computing technology. Companies will continue paying for Microsoft services even during recessions because they're essential for operations. J&J benefits from inelastic demand for healthcare. People need medicine and medical treatment regardless of economic conditions. Third, they both benefit from long-term secular trends that are unlikely to reverse. The shift to cloud computing and artificial intelligence will continue for decades. The aging of the global population and increasing healthcare spending will also continue for decades. Fourth, they both have exceptional management teams and financial strength. Microsoft is led by Satya Nadella, who has successfully transformed the company and positioned it for future growth. J&J has a deep management bench and a corporate culture focused on long-term value creation. Both companies have strong balance sheets, generate enormous cash flows, and return cash to shareholders through dividends and share buybacks. Fifth, they're both global leaders in their respective industries, with competitive advantages that are difficult to replicate. Microsoft's ecosystem of integrated software and cloud services creates customer loyalty and switching costs. J&J's regulatory expertise, manufacturing scale, and research capabilities create barriers to competition. Now, let me address the risks, because every investment has risks. For Microsoft, the biggest risk is competition from other technology giants like Amazon, Google, and Apple. The technology industry changes rapidly, and dominant positions can erode quickly if companies fail to innovate. There's also regulatory risk. Governments around the world are scrutinizing large technology companies and considering antitrust actions that could limit their growth or force business model changes. Valuation is another risk. Microsoft's stock price has risen dramatically over the past decade, and it's possible that future returns will be more modest if the company's growth slows or if investors become less willing to pay premium valuations. For technology stocks, for J&J, the biggest risk is pharmaceutical patent expirations. When patents expire on major drugs, generic competition can cause revenue and profits to decline dramatically. There's also litigation risk. J&J has faced lawsuits related to talc products, opioid sales, and other issues. While they have insurance and reserves to handle legal costs, major adverse judgments could impact financial results. Regulatory risk is also significant for pharmaceutical companies. Government agencies can reject new drug applications, require additional clinical trials, or impose pricing restrictions that affect profitability. Despite these risks, I believe both Microsoft and J&J are positioned to generate attractive returns for long-term investors. The key is having appropriate expectations and position sizes. I wouldn't put all my money in these two stocks, no matter how confident I am in their prospects. Diversification is important for managing risk, but I would be comfortable having 10% to 20% of a portfolio in Microsoft and J&J combined. I would also approach these investments with a long-term horizon. I'm not buying these stocks to flip them in 6 months or a year. I'm buying them to hold for decades to benefit from compound growth, dividend increases, and the long-term success of their business strategies. At JP Morgan, when we recommend stocks to our high-net-worth clients, we always emphasize the importance of conviction and patience. The best investments often don't look attractive in the short term. They work because you hold them long enough for their fundamental advantages to create value. Microsoft and J&J are exactly those kinds of investments. They're not going to double next year, but they could easily triple or quadruple over the next decade if their business strategies succeed. And if you have the patience to let compound growth work in your favor, that's why these are the two stocks I'd buy in 2026, without hesitation. Not because they're guaranteed to outperform, but because they represent the kind of high, long-term investments that have created wealth for generations of investors. The question isn't whether they're perfect investments, the question is whether they're better than the alternatives, and whether they fit your investment objectives and risk tolerance. For me, given everything I know about markets, business strategy, and long-term wealth creation, the answer is yes. These are the two stocks I'd want to own for the next decade and beyond. In my 4 decades in banking and finance, I've learned one critical lesson: be extremely cautious about stock picking. I've watched brilliant people lose fortunes chasing hot stocks, betting on companies they didn't understand, or following investment fads that became disasters. At JP Morgan Chase, we manage over $4 trillion in assets. Our approach to individual stocks is methodical, research-driven, and laser-focused on companies with sustainable competitive advantages and predictable cash flows. We don't chase momentum. We don't bet on speculation. We invest in businesses we understand, with management teams we trust, in industries where we see clear long-term growth. That said, there are 2 stocks I would buy in 2026 without hesitation. Not because they'll double overnight, not because they're the next hot thing, but because they represent exactly the kind of companies that build wealth steadily and reliably over decades. Companies that will be more valuable in 10 years than today, regardless of what happens to the broader economy or stock market. These aren't speculative picks. These aren't tips or hunches. These are investments based on fundamental analysis, competitive positioning, and long-term secular trends that I believe are unstoppable. The first stock is Microsoft. I know what you're thinking. Microsoft isn't exactly a secret. It's one of the largest companies in the world with over $3 trillion in market cap. It's been a phenomenal performer for the past decade. How much more can it grow? But here's what most people miss. This isn't the same company that dominated personal computer software in the 1990s and 2000s. This is a fundamentally different business that has reinvented itself for the cloud computing era, positioned to benefit from some of the most powerful technological trends of our time. Microsoft's business model has transformed from selling software licenses to providing software as a service. This creates what we in banking call recurring revenue streams that are incredibly predictable and valuable. When Microsoft sold Office as a one-time purchase, they got paid once and had to convince customers to upgrade years later. Now, with Office 365, they get paid monthly or annually by hundreds of millions of subscribers. This creates steady, growing revenue that's far more valuable than one-time sales. At JP Morgan, we've analyzed Microsoft's subscriber growth and pricing power. The numbers are extraordinary. Office 365 commercial seats have grown from essentially zero in 2012 to over 400 million today. Each seat generates $8 to $20 per month in revenue, creating billions in recurring revenue that grows every quarter. But Office 365 is just the beginning. Microsoft's Azure cloud computing platform is the second largest cloud infrastructure provider in the world, behind only Amazon Web Services. Azure is growing faster than AWS, gaining market share in what may be the most important technology trend of the next decade. Every company in the world is moving their computing infrastructure to the cloud. This isn't a fad or temporary trend. This is a permanent structural shift in how businesses operate. Companies that don't move to the cloud will be at a competitive disadvantage in cost, flexibility, and scalability. Microsoft Azure benefits from this trend in two powerful ways. First, they get paid for hosting companies' computing workloads. Second, they sell additional services like databases, analytics, artificial intelligence, and security tools to those same customers. This creates what Microsoft calls their land and expand strategy. They win a customer with basic cloud services, then sell them additional services over time. The result? Average revenue per customer increases year after year. Our technology analysts at JP Morgan estimate that Azure could reach $100 billion in annual revenue by 2028, up from about $60 billion today. That's massive growth in one of Microsoft's fastest growing divisions. But here's what really excites me about Microsoft. Artificial intelligence. Microsoft has made a massive bet on AI. Through their partnership with OpenAI, the company behind ChatGPT, they've integrated AI capabilities into virtually every Microsoft product: Office, Windows, Azure, even their search engine, Bing. This isn't just marketing. AI is fundamentally changing how people work with software. Instead of learning complex menus and commands, users simply describe what they want in natural language, and the AI does it for them. Microsoft is charging premium prices for AI-enabled versions of their products, and customers are paying willingly because the productivity improvements are so significant. Office 365 Copilot, their AI assistant, costs an additional $30 per user per month on top of regular Office subscriptions. That's a 50% to 150% price increase, and demand is strong. At JP Morgan, we've started using Microsoft's AI tools internally. The productivity gains are real. Tasks that used to take hours now take minutes. Complex analysis that required specialized skills can now be done by anyone with basic computer literacy. If Microsoft can successfully integrate AI across their entire product portfolio and charge premium prices for AI features, the impact on their financial results will be enormous. But even without AI, Microsoft's core businesses are incredibly strong. Windows still runs on over 70% of desktop computers worldwide. Office still dominates productivity software. Azure is gaining cloud market share. Xbox is a leading gaming platform. These are not businesses that are going away. These are essential tools that businesses and consumers depend on. They have what Warren Buffett calls economic moats competitive advantages that protect them from competition. Microsoft also has an exceptional balance sheet. They generate over $80 billion in annual free cash flow. They have minimal debt, and they return enormous amounts of cash to shareholders through dividends and share buybacks. The dividend alone makes Microsoft attractive for long-term investors. They've increased their dividend for 21 consecutive years, and the current yield is about 0.7%. While that might seem low, remember that Microsoft's earnings and cash flow are growing rapidly, which means the dividend will likely grow rapidly too. From a valuation standpoint, Microsoft isn't cheap, but it's not outrageously expensive either. The stock trades at about 30 times earnings, which is reasonable for a company growing revenues at 15% to 20% annually with such strong competitive positions. At JP Morgan, we have Microsoft rated as a buy with a price target 20% above current levels. But more importantly, we see Microsoft as a long-term compounding machine that could easily double or triple in value over the next decade. The second stock I'd buy without hesitation is Johnson & Johnson. This might surprise you because healthcare stocks don't get the same attention as technology stocks. J&J doesn't have the growth rates of Microsoft or the excitement of AI. But what J&J has is something even more valuable for long-term investors: predictability. Johnson & Johnson is one of the most reliable, stable, profitable companies in the world. They've increased their dividend for 61 consecutive years. They've generated positive earnings growth in almost every year since the 1940s. They've survived and thrived through dozens of economic recessions, market crashes, and industry disruptions. This isn't an accident. This is the result of a business model that's fundamentally defensive and essential.